Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 10% off, you can use code A1TradingDF10. Again, that will be a 10% discount off of any of their trials you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. Hey guys, I just wanted to jump in for a second and let you know.
All right. Good morning, guys. Welcome back to another live stream. Hope you're doing well. We have got plenty to talk about here. Hopefully my mic is a little bit better audio today. Yesterday, I guess my mic was just not correctly attached. I was using my webcam mic, which was worse. But hopefully it is all set. Should be sounding better than yesterday. But in this live stream, we're going to, sounds good. Okay, cool. We're going to be taking a look at some currencies. We're going to look at some indices, look at commodities, all the usual suspects. Let me just get my mic or my camera slightly. There we go. So first of all, the dollar index actually pulled back to that level we've been discussing, this area of support right around 108. Did come back into play. I actually ended up taking a position on the dollar, so we'll see how that can go or how that goes. S&P 500, look at how beautiful this chart is, man. The S&P 500 is very close to testing all-time highs once more. In fact, are we there? Let's see. Are we at all-time highs? Just shy of the all-time highs in the S&P 500. Markets continue kind of just ripping higher, it seems. And I think that there were a lot of fears that tariffs would come out of the gate swinging big time. And while there is still, we're on tariff watch, it seems like tariffs are not going to be like an instantaneous, all at once bombardment that many people were thinking. People have been scared about that for months. Everybody's saying, oh, with Trump, winning is going to be massive inflation and tariffs everywhere. And it does still seem like tariffs are on the table, but clearly there's not like this massive sweep of tariffs everywhere. And perhaps that's another reason why the stock market continues to go up, is people are like, okay, maybe the Trump administration is going to roll them out slow and steady rather than all at once. And the market's probably happier with that. Because again, all at once would mean drastic, sudden change, and rolling them out over time is a little bit more hospitable of an environment for the market. I would guess, right? Nick, 2 questions. Are you going to be live streaming the Trump speech tomorrow? And 2, could you add a stagflation gauge to the Edge Finder? I don't know. I don't know if I'm going to stream that tomorrow. What time is it tomorrow? It depends with if our schedule suits it, but maybe we can look into that. If it's something that would be very market moving, possibly. And then a stagflation gauge. Stagflation is just the idea that you have rising prices and slowing growth, which the Edge Finder kind of already shows you that. For example, you could take a look here on this page. Stagflation, this is the US economic heat map. And by the way, guys, we've had enough requests already to go ahead and make not just the US economic heat map, but we're going to add UK, we're going to add Europe, and we're going to add Japan. So that is on its way by popular demand. People love the new US economic heat map, which I'm thrilled about because I love it too. But we are very quickly, we've added new projects to our to-do list, and projects take a while. As you guys can imagine, this stuff does not build itself. It takes a lot of work to build new tools in the Edge Finder, but we've got some new projects on the books already to add not just the US economic heat map, but we're going to build a European heat map, a UK heat map, and a Japanese economic heat map. So definitely exciting. Also, I just need to check our stream schedule because I just got a message. I'm doing a podcast after this, and I want to make sure I'm on schedule for that. By the way, you guys can do what I'm doing anytime you want. Head over to a1trading.com, click live stream schedule, and you can see what time everything's going on. So we've got, okay, cool. I could do, yeah, I'm going to leave James at 9:45. James Chandler, if one of you guys could just adjust this slightly, I'm going to hop off at 9:45 so that I can do a podcast at 10. Sorry for I should have done this before stream, but somebody asked me, can you do podcast at 10? Yes. Okay. Okay. Sorry about that. Should be good to go. I do a podcast twice a week with Johnny Hart from, he's also on the content team for Market Pulse, but we're going to do a podcast today, 10 a.m. So we'll do that 30 minutes from now. Anyways, S&P 500 is making a push here. Things look really solid for U.S. stocks. I don't know if you guys saw this, but Netflix also reported their earnings, and up it goes. Check this out. You can't see it on the screen. That's because it's way up at $1,000 per share. Netflix absolutely ripping. And yet again, this is just a company that just wins and wins and wins. And a big reason for the hype around Netflix stock specifically is that they are starting to take over the live sports arena, for lack of a better term. Netflix stock is up 15% here today. They had great earnings. They reported excellent outlook, and with the live sports stuff coming down the pipeline for Netflix, this is a really strong day for Netflix stock. Again, trading at $999 per share. What's crazy about Netflix is that just a few short years ago, it was down at 175, right? So think about that. If you had bought that dip in Netflix, obviously I'm cherry picking here, but that puts you up 430 something percent on the stock, which is crazy. But yeah. Nick, shouldn't the heat map be done by actual versus previous and not actual versus forecast for optimal results? Definitely not. And I'll tell you why. We actually used to do it that way, but that is definitely the wrong way to do it. Because if you're doing actual versus previous, it doesn't account for seasonality, right? So here's the thing. CPI has seasonality to it. All of these things, jobs data, for example, has seasonality to it, right? People typically get hired less during the holidays. So if you only ever look at previous to now, it's actually a very bad indicator of growth or not, because almost always you're going to see a decline or a gain in certain parts of the year if you only look at previous versus actual. So instead, what we do, which is, in my opinion, far superior, is take a look at the actual numbers that come out compared to what the analyst community is forecasting. This will give you a much better read as to whether or not the data coming in is strong compared to what the market thought or weak compared to the market thought, right? We don't look at previous because previous to actual does not tell you all that much. There's seasonality mixed in, and there's just inevitably, it's going to be a weaker read on the economic data. But if you do actual to forecast, that's where the intelligence comes in. It says, look, everybody forecasted for the unemployment rate in the United States to go to 4.2%. It went to 4.1%. That's strong, right? But if you only look at the previous, then that doesn't give you the full picture, right? Does that make sense? Can you upload the podcast to platforms, to other platforms also? Look, I don't own the podcast. I'm just a contributor to it. So they put it, I'm not actually sure where all they put it. I know they put it on Spotify and on the marketpulse.com website, I believe, but that is where they put that. But I mentioned this earlier, guys. U.S. economic heat map is up and running. but we are going to be adding the UK, Europe, and Japan to this list. And I can't wait for that because I think it's going to be a game changer. It will give you an all-in-one spot to look at economic data for selected countries. And I think it's probably the best thing I've seen on the market for that kind of instantaneous, easy access, look at the economies of different places based on the core metrics, actual versus forecast, all of this data updating automatically for you. Again, that's why we built this table, is to make it simple, right? You can look at the US economic heat map, and within just a second or two, you can get a general idea. If there's a lot of blue on this screen, it means risk on, generally speaking. And if it's a lot of red, it's more risk off, right? But yes, by popular demand, we've had so many requests. Hey, can we get a UK? Hey, can we get a Europe? Hey, can we get a Japan? So we're going to do those three, and we'll roll those. Roll those out within the next few weeks. So stay tuned. When, Nick? Yeah, next few weeks. These things take time, but we'll get them out as quick as we can. Because again, like I said, by popular demand, we had tons of people send us that message right away. I thought my initial thought was like, oh, U.S. economic data is the most critical to most traders. But then immediately many people were like, well, can we also see the other ones? So those heat maps would be so handy. Yeah, I'm telling you, the amount of feedback that we have gotten, like in the first week of having this up, has been phenomenal. Also, while we're talking about this, if you do not have the Edge Finder, it is free until Monday. If you do not have the Edge Finder already and you missed yesterday's announcement, the Edge Finder is completely free right now. It's not free forever. We wouldn't be in business, and all these tools would cease to exist if we weren't in business. We build, we maintain, we develop all this stuff. But for a very limited time, this stuff is free to use until Monday. If you do not already have the Edge Finder, you can access it for free for a very limited time. I've said this many times. This is absolutely a way for us to market ourselves and to collect interest on our products. If you are somebody who is serious about this stuff but would like a chance to try it for free, this is very limited. We do not usually do this. So this is an opportunity for you to try it for free. And within 1 minute from now, if you click that link and fill out that link, the requested information on that, we will email you a link to the Edge Finder to play around with it for yourself. So there you go. Don't miss that chance. Again, we do that very rarely. But we have a lot of new features we've been working on, and we want to get more people the chance to try it out. So NASDAQ is up 0.8% here. Look at this chart, guys. NAS looks excellent. NAS looks very, very good. Breaking out of this kind of downward structure that we saw. We even saw, this is the icing on the cake, breakout, retest of that same trend line area, and shot off of that area. NASDAQ looks primed, in my opinion, as I've said for the last few weeks here, to return to those highs and potentially break out. If I take a look at the S&P 500, I think it looks even better. The S&P 500, which I have a trade on right now, did the same kind of thing. You can see we broke out of this downward trend line structure, then retested the area, shooting through. This is why I love the daily chart, is I feel like I get such a clear picture on the daily chart of what's happening, right? We consolidated for a while, but we stubbornly held this support area. I bought into this area, and my entry was not perfect because we did take some heat on the trade, but it reversed course beautifully. And so I'm not an ICT or a smart money concepts trader or a Wyckoff Springs. You guys know Richard Wyckoff, if you've ever heard of him. He's like the original accumulation, distribution, manipulation guy. He found those topics like, I don't know, in the 50s or something, like way a long time ago. Anyways, there's one thing about the Wyckoff methodology or whatever. It's called the Wyckoff Spring. And years ago, I remember my dad and I were sitting in the living room and we were studying Wyckoff stuff. And the Wyckoff Spring method or idea is that oftentimes before you get these very big breakaway movements, like we're seeing on the S&P 500, you get what is called the Wyckoff Spring. Has anybody heard of this before? Anybody heard of the Wyckoff Spring before? I'm going to go ahead and stop right here though, and just tell you, I'm not speaking voodoo magic. I actually think, to be completely honest, technical analysis, in my opinion, is completely overrated, but I use it. So I'm not saying it's useless. But the Wyckoff spring method is going to sound like candy. It's going to sound like icing on a cake. It's going to sound like lose 25 pounds in 20 days nonsense. But it sometimes is magical. So let me show you. The Wyckoff spring method is the idea that when you have a key support level, and many traders call this, you can call it whatever you want. I don't care. You can call it a liquidity grab. You can call it false breakout. You can call it a Wyckoff spring. Doesn't really matter what you call it. It's simple trading psychology. Nobody invented this stuff. This is just human nature. Okay, look, we have a support level that everybody is watching. Then that level gets tested and briefly trades underneath that level that everyone is watching. At that time, whether you call it a liquidity grab, a false breakout, a Wyckoff spring, whatever, heavy-handed buyers rush back in quickly, recapturing that area. And all the people that got psyched out to the downside thinking, oh, it's breaking out to the downside, or it's breaking down, it's failing out here, they reverse course, they short cover, and the buyers rush back in, oftentimes causing these very violent moves higher. You can call it whatever you want. For example, Abdul calls it a trap and break, right? Last push before the rally. Completely don't care what you call it. You can call it a Wyckoff spring. And I like Wyckoff spring because, of course, that's like my roots. I think 10 years ago, my dad and I were sitting in the living room watching videos and reading about Richard Wyckoff's methodologies and fascinating stuff. It's kind of like nostalgic for me to think about. But this idea that you've got a spring, you've got accumulation occurring, and then the spring winds up and you get this false break to the downside and the spring unwinds quickly, shooting us to new highs. Again, have your fancy, call it whatever you want, have fun with technical analysis. But at the end of the day, technical analysis is useful, but it is not what made me profitable. Fundamental analysis absolutely is way more important, in my opinion. You do your thing. You can call it whatever you want. ICT calls it turtle soup. Cool. You know, like do whatever you want to call it. I don't care. But the thing is here, it's nothing new. Nobody invented it. Nobody owns it. It's a key level of support. It looked like it was going to break, and then it absolutely did not, and it reversed and violently reversed the other way. It's a fake out, right? It got everybody thinking it's going to do one thing, and it went the other way. It happens for 1,000 years, since the Japanese used to trade rice with candlestick patterns, right? Nobody invented this stuff. It is just simple human psychology in the form of a candlestick chart. So anyways, nice little reversal here. We saw it again, right? We saw it again. It looked like we came up to resistance, shot through those lows, and then reversed course higher. S&P 500 looks excellent right now. To me, the path of least resistance is new highs, and that is why I'm still in the trade. I've got a stop loss trailed below this little swing low. And let me clarify, had this thing done this and then broken through those lows, then it's a real signal that it's okay, we're probably just going lower. But this rejection off of this rejection off of this, very strong signal that the market wants to continue, at least for now. And if it doesn't, if it breaks out and fails at those ideas or those levels, then my idea was wrong. But we'll just take the profit there. So I have a trade running on the S&P 500. I'm also long Bitcoin, which is getting tested a little bit more here today. Again, support right around 99,000 right around 99,000 is about where I'd hold on to it. If we break back down into the 90s here, that's going to be my signal to take profit on this move as well. So I've got a couple trades running on the long side, Bitcoin, long side of S&P 500 as well. Take a quick look at the dollar here. Dollar pulling back. I actually picked up a long position on USD CHF this morning. Let me see if I can show you what that looks like here. Give me a second. Go to Forex trades. And yeah, so I bought a initial position on the USD CHF. I've been trading this thing a lot here recently. It pays a positive swap to hold it, so I don't mind holding it for weeks at a time if needed, but or months even, really. But I took up an initial position on the USD CHF right around this area of support. I have willingness to buy more of this currency pair should we see larger pullbacks. I would love to see actually a larger scale pullback on the dollar, at which point I could add some longs and build a position on this one. So I don't mind the initial trade here. If it wants to rip back higher, that's been what has been happening to me with these trades. Is I've been buying in for my initial buy and then just rips. Buy in for my initial buy and then it rips. Buy in for, well, this was an attempt, made profit there, bought again, closed it and bought a new setup, and then you can kind of see what has been happening. But if it wants to pull back further, that'd be great. I could get a bigger position built. But if it doesn't, I'll just keep pocketing the profits and moving on. Also, I want to say one last thing about the Wyckoff Spring stuff. I don't place trades based on it. So even though it sounds fun and it's candy and it's technical analysis traders just go crazy for it, here's the reality is a lot of time you can get all fancy, but sometimes just buy support levels. If you like the fundamental story, don't waste time thinking about, oh, I'm going to wait for the false breakout and everybody's going to convince and then I'm going to entry. Well, oftentimes that just leads to you missing the trade that you are all correct about, right? So in actual terms, you might say, oh, I'm going to wait and buy it down here. I don't do that at all. That's, to me, is silly. Just if you really like the fundamental story, you buy levels. You do what you want, but I don't wait for confirmation, and I don't like wait for false breakouts or fancy cute candlestick patterns. I don't do any of that. I wait for key levels that I'm looking at to get hit, and I buy at support or I sell at resistance if I'm bearish on a chart. Keep it so simple. You don't have, like, if you sit around and you say, I'm going to wait for this exact setup to happen and it's going to work every time. Well, guess what? Number one, it's not going to work every time. Sometimes you're going to buy this thing thinking you're so smart for doing that and they're just going to do this, right? It's not 100%, first of all. Second of all, a lot of times good levels are only there for a brief moment in time before they rip, right? So this chart setup right here, key support got hit. If you missed that entry trying to get fancy waiting for a technical fake breakout, you missed an excellent move, right? So my point is, you do what you want, but I don't like to get all fancy and cute about my technical analysis. Focus on what matters, the fundamental analysis side of things, and then use technical analysis for entries and managing your risk. That's how I do it. Keep it so simple. Support and resistance does work. Technical stuff that is deemed retail trading strategies does work if you know how to apply it and you apply it with fundamental analysis. That I will preach that forever because that is what has worked for me. And I say truthfully, I've made a lot of money with very simple tactics technically, but I don't make my money from technical analysis. Technical analysis is just execution part. Fundamental analysis is picking the right charts and picking the right charts and why I want to buy or sell them. And then technicals is just when I get in and when I get out. If somebody wants the Edge Finder, again, it is free right now. We'll drop the link one more time if you guys want to try it out for free this week only until Monday. The Edge Finder is public access. You can use all of our tools, commitment of traders data, retail sentiment, put to call ratio, all of our data screeners. All of it is free for a very limited time. Use this link, fill out the form. We'll add you to our email newsletter. And if you don't want to be on there, you can unsubscribe at any time. That is the full transparency. This is a way for us to build up a marketing list of people who may be interested in buying our tool in the future. And if you're not interested in buying it in the future, no worries. Check it out for free. Enjoy it this week. And we appreciate you taking the time to check out our work. Free for until Monday. If it was free forever, people love to say, Nick, it should just be free forever. Well, if it was free forever, we wouldn't be in business and there would be no Edge Finder. The Edge Finder is a premium product, just like everything else. It costs money to run. It's an excellent software, but our team is working for a living too, right? So we don't work for free, but for a limited time, you can try it out for free. This is a great way for us to just allow the community to check out our work, see if it's right for you, and maybe purchase it in the future. That's kind of our transparent marketing about what we're doing here. Okay, guys, up next, we got Forex James taking over the show. I ran over by 2 minutes, so sorry to James. He's going to take over the show here for a little bit. Stick around. He'll be going over some technical setups and ideas in the market We'll be right back just after this.
For a very limited time, the Edge Finder is now free to use to the public. We are going to be offering the Edge Finder to everybody who would like to try it out during the dates that you see on the screen right now. January 20th officially is going to mark the full week access available to the Edge Finder. Now, I do want to also just make sure that we clarify this. The Edge Finder will be available from January 20th until January 27th for everyone who would like to try it out. Now, again, this is free to access, and all the information, if you would like to take advantage of this trial period, all of the information can be found in the description down below of this video. You'll need to apply for access, and we'll get to you as quickly as possible to fulfill your trial access so that you can check out the tool and see if it's right for you. Also, the Edge Finder, should you decide to purchase it, is a one-time payment to get access to. Yes, that is right. It means that you pay once and then you have access, you get unlocked access to all of our tools, and you don't have to pay monthly. So don't miss your chance. Try it out for the week, see if it's right for you, and if you like it, again, consider purchasing a copy for yourself.
Hello. How's everyone doing? I already see some people in here. We've got Bashi, Babu, Lee. Hey guys, how's everyone doing? Hope you're all having a good week. So, just to answer the business question, because obviously I run a service as well, so I can answer it from my perspective. The thing about one-time payments and subscriptions is benefits, well, pros and cons to both sides. So, for example, we don't have a one-time payment at my service because we don't want a one-time payment. We're happy to have a recurring revenue. So obviously we can make sure we pay everyone on time every month and it's all good. So, for example, if it was a one-time payment and we didn't get any memberships for that month, then we would have no cash flow. Whereas there are other sides, obviously with subscriptions, we get cancellations, our memberships drop and go up, and it's a little bit more volatile, I guess you could say. So that's basically it. It just depends on how you run business and your finance and all that sort of stuff. But that's basically it. So it doesn't really mean much. But to be honest, if you can pay one time, it's normally better if you like the service. So let's get into it. I also want to just quickly update you guys on my trading. So I had a little bit of a rude awakening, sort of the end of last week to sort of the start of this week. So the capital gains tax in the UK has been decreased, which I knew, but to be honest, I completely forgot about. So that means I'm going to have to move back towards spread betting. So I'm still in euro dollar and pound dollar. Euro dollar and euro pound shorts on my MetaTrader account. So that's still alive. But I'm just going to close out those, manage my way out, and then start transferring over to spread betting again. Because spread betting is tax-free in the UK, whereas CFDs are classed as capital gains. So it just makes things a lot cheaper and a lot easier for me. So that's that. Of course, I'll still share all the track records and broker statements and things from that. But, I don't want you guys getting confused when you see me slowly switching over to a different platform. Rudy, hello. Anwin, good to see you guys. Anyway, let's go on to the charts. As Nick said, yes, one-time payments are generally better. Obviously, it's better for you to funnel money into capital every month rather than services. So gold, let's have a look. Gold did have a breakout of the resistance. I think we spoke about this a couple of days ago. Royal Trades, hello, good to see you. Sean, hello. So, yes, we did have the breakout of resistance on gold, which is a positive sign for the bulls. Obviously, the bears are not going to be very happy about this. However, I would now shift more towards going long on gold. Mainly based around sort of inflationary pressures on the US, but it's not, in my view, it's not the best trade there is. So the only opportunity I would be happy to go into on gold is if we saw, well, we've got the breakout. If we could have this retest of the resistance and then continue to the upside towards 2,800 and create a new high. At the moment, it's obviously too late to start buying, and there isn't really much of a reason to go short in my view. So yeah, that's basically all I see here on gold. It's just waiting for that retest. Sean, not for trading, no. So obviously Elite Traders is set up as an LLC in America, but I don't trade under Elite Traders. I trade under me. So it's a lot more beneficial for me to just use spread betting, which again is tax free. But yeah, I don't want to be paying tax if I don't have to. Hey James, I was wondering if you could break down what's been happening to the US dollar past couple of days, because it seems rather confusing for me at least. Yes, Cal, the US dollar has been, yeah, quite confusing. I've been a little bit mixed up on the dollar as well. So the way I see it, we had quite a few things running in favor of the dollar. We had positive labor market. We had rate cuts slowing down, now looking towards more likely a rate hold this month. So this was all very good for the dollar. We obviously had the Trump rally as well. However, we've had a bit of a cool down on the US data. It looks like we are going to see a little bit more rate cuts from the US, possibly in March, I think is the projection. And the Trump rally seems to kind of be over now. Obviously, Trump's in office, and if we look back in 2016 when he came into office back then, we see the same thing. So we had the rally to the upside, and then we had a pretty nasty 15% drop down. So we could be looking at a very similar thing where we just see the market relax. You know, again, the sort of market conditions have slightly changed. I mean, in my view, the dollar is still bullish. I don't really see a reason to get short yet. So I would be more expecting a rejection here and continuation to the upside. So we'll have to see how that goes. But that's basically it with the dollar. We just had a little bit of unwinding, I guess you could say, or repositioning in the markets. Tom, good to see you. No positions open for the Bank of Japan decision. The yen isn't something I trade very much, at least these days, so I'm kind of sat out of the yen. I do expect them to hike rates, but the Bank of Japan can be a little bit tricky to try and trade around. So it's, yeah, not my favorite thing at the moment. What impact does that have to the brokers? So I use for spread betting. So I use two accounts. I mean, I've been quite open about this, but for anyone that doesn't know, I have two trading accounts. So I've got the small account that I use for sort of public things, which is the CFD account with Blueberry Markets. But my main account is on IG Market spread betting, and again, that's because it's tax free. So I don't really, excuse me, I don't really have to worry about how much I make or filing taxes on it or anything like that. So it's just a lot easier, which is why I'm just going to shift over again the public account to spread betting. Don't you think that gold demand is maybe rising because people want to use it as a hedge against inflation now with Trump? Yeah. Under Trump, we'll see $90 index, possibly. I know the current dollar strength isn't ideal. We covered this again in one of the previous segments I was on, but a strong dollar makes it very difficult for other countries. It's not strong currencies obviously sound good. You know, we can just buy them and leave it. But generally, it's not great to have a super strong currency. You also don't want a super weak currency. Obviously, the dollar has been dominated or dominating against other currencies, especially the G10 currencies. So when we have a super strong dollar, it makes it very difficult for other countries with lower value currencies to pay back debts. It makes imports, exports a bit more difficult. So it's generally not ideal. So yeah, it would be expected to see a slightly lower dollar price soon. Maybe not soon, but eventually. AB, you want to have a look at the indices? Sure. Okay. So indices, we'll just focus on the US indices for now, unless you want the European ones. US indices seem like they're on a rally. We were looking at this descending trend line previously. Now, I wasn't super comfortable to buy into this this downside move. I mean, it's a very classic downtrend. We're having lower highs, lower lows, following this descending trend line quite smoothly. So that, to me, just put me off from a technical aspect. Obviously, I trade mainly on market drivers, but I do still need technicals to be in my favor or to be, favorable. And in this situation, they just weren't. So unfortunately, I've missed this upside move. But if we are looking here, we've got a very clear trend change here on the H4 to the upside. We've broken out of the descending trend line. We've had a moving average cross. So that looks fine to me. We've got the RSI here that's a little bit overbought. So I would be expecting some sort of pullback. On the pullback, I'd be quite happy to start looking to go long potentially. In terms of an entry, if we use the fib, we have a look at previous levels. It almost lines up quite nicely. It's not perfect, obviously. The markets are never perfect, but to me, that's good enough, to be honest. So I'd be quite happy to go long here. Stop loss below the wick that we had at 21,200. Take profit at the fib extension to create a new high at 22,241. So this looks good. It gives you almost a 1 to 2, slightly under to 1 to 1.95, but that's fine in my book. I think the Nasdaq's very similar. The S&P is very similar. It is. So I'd be expecting the same thing on the Nasdaq, some sort of pullback, and then potentially buy into the next pullback. The Dow is obviously slightly different. In terms of technicals, I would be looking for something similar, though. Some sort of pullback. We've had the moving average cross very clearly moving to the upside, broken this downside momentum that we're in. RSI slightly overbought, which makes me think we are heading or due for some sort of pullback here. Nothing too major, but just some sort of move down. Similar thing here, stop loss just below the wick. And yeah, looking for a continuation to the upside. Yes, I do have a Discord, Jay. It's just elitetraders.io. If you put that into your search bar, you'll come up with my website. We focus on, we've got a commodities and emerging markets trader, and I focus on G10. So we've got a nice mix of assets in there. Copper pushed down and broke the downwards trend line on the daily. Do you think it would bounce on a strong retest? Before we actually go on to more markets, let's just have a quick look on what's in the Edge Finder. I've not checked that yet. Can you not just tell your accountants here spread betting HMRC won't check? Gareth, you know what? If I felt comfortable lying to HMRC, I would be quite a wealthy man. But unfortunately, HMRC is really cracking down. I'll make this short because I know not everyone's in the UK, but HMRC is now in contact with a lot of small companies, places where people sell things. So like eBay, Vinted, all these places, they are really cracking down on taxes and making sure people are paying. And the last thing I want is to end up being caught with a big tax bill. So it's just easier to follow the guidelines and jump through any loopholes that you can find, which in my case is spread betting. So we've got copper as reading bullish. So that tells me already that I'm looking to buy copper. So if we look at the technicals, we should probably add copper to the watch list, actually. It seems like we're holding up this support. We have broken out of this trend line to the downside. Let's see, actually, is there a fib here somewhere? Not from that low. What about this one? Kind of. It's not perfect. Again, you've got to kind of botch it. It depends if you class this as a previous low or not. In my book, I do, basically. It is what it is. So I think if I was looking to buy copper, this would be really the only level I'd be interested in right now. However, if we do continue to drop, then I guess the next level would be this low at sort of where we are, 4.1. But again, keep it simple. No need to overcomplicate it. This is how I would approach it. Again, the Edge Finder is bullish, so I'm only looking to go long. Today you're not charging to show stop loss. Last time I actually said $100. Well, it depends. If I'm in an active trade, then yeah, I'm not going to, and it's its entry or, roundabout there. Yeah, I'm not going to tell you because that's what people pay for. That is my service. That's my job, essentially. But if I'm just marking up charts, then, it's not a problem. Yeah, definitely not going to jail. Definitely not going to jail for that. So if we look, yeah, the euro and the pound did spike up yesterday. Obviously, as we saw outflows of on the dollar, we saw inflows on euro and pound. That seems to be depreciating a little bit now as we are seeing the dollar start to strengthen again. So actually, let's just take a look here. Yeah, so this isn't moving too much. This is a pretty small account at the moment, still starting to move money over to it. Euro dollar actually is what I'm in, so I'll go over euro dollar here. So the reason I entered here is because although I'm not quite as confident in dollar longs as I once was, I still view this market as bearish. I'm still very comfortable to say that euro dollar is favored to the downside. Again, we saw, or we are currently seeing, depends how you look at it, but the dollar isn't exactly doing the hottest right now. Although the fundamentals, the drivers behind the dollar outweigh the euro quite significantly still. There's also something I actually wanted to show you, which is here. So this is from UBS. This was sent out. There's not actually a date on here, I don't think. Well, it was sent out yesterday. Oh, there we go. 2 days ago, sorry, 20th of January. So UBS is currently looking for shorts, or talking about shorts at least. So we can see euro dollar set for another leg down. So a firmer US economic activity is likely to trigger a test of euro USD parity before the pair moves higher again into the 1.05 to 1.1 range towards the end of the year. So essentially what we're looking for is a continuation. It might not be now, it might be next week, it might be in 2 weeks, but we're looking for a continuation down to parity on euro dollar before we start heading back to the upside at the end of the year. We adjust our forecast lower to 1.0, which is parity, 1.02, 1.04, and 1.06 from 1.05. Feel free to screenshot this, by the way. I'm going to sort of ramble through it. At least in the short term, the need to hedge US dollar longs is not warranted anymore in our view, but the dollar is trading on the lofty side. Managing excessive exposure will likely remain a hot topic for the latter part of the year. So again, feel free to screenshot because I'm not going to read all this if you want to. But yeah, basically institutions, at least UBS, is still looking to short euro dollar, which is a nice confluence for me. So if we look on the technicals, didn't mean to draw that arrow. If we look on the technicals, we've had a pretty solid pullback. On the daily, it doesn't look like much, but it has allowed some more sellers into the market. We've also got some buyers out of the market, so it would be the most sensible place, in my view, now to continue that rally down. We do have this really nice level of structure. We've just broken above our 200 moving average on the H4, which to me doesn't look unbroken yet in terms of the trend. So I'm quite happy to stay short for now. If we do start breaking above this level and we see a continuation higher, that's when I'm going to be possibly changing my view on the euro dollar. But again, at the moment, it's kind of unchanged. Favorite dollar bullish pair? Probably euro dollar. New Zealand dollar is also a really good pick. Go offshore, maybe eventually, but right now I'm quite comfortable doing what I'm doing. So the Russell, I don't trade the Russell, so I can't really give you lots of insight. However, with the likelihood, actually, let's just have a quick look and see what the current rate probabilities are for the Fed. Next month hold. So if we have a look, March cut. Actually, was that cut? Sorry, no change, but we still got a 26% chance of a cut. March, yeah, okay, interesting. Okay, so if we are looking for further cuts, not immediately, as I said, this month looks like we are going to get a hold, but it looks like we are pricing in some further cuts by the Fed this year. So it would make sense that we are going to continue slightly higher on the Russell. Where to? No idea. Again, it's not something I trade very often. I don't really know the behavior of the Russell. But generally speaking, possibly not now, because again, we are heading into a hold. But possibly after we've had the hold, I'd start looking to position to the long side on the Russell. So obviously lower interest rates are beneficial for the Russell, makes borrowing a lot easier and a lot cheaper for these smaller companies. So let's just have a quick look here. So ideally, I'd be looking at this support. And this obviously is only if we can get this move to the downside. If not, then I'm probably not very interested. But if we can see the support level get hit again, maybe a long position will be of interest back into this resistance. Pound dollar. Let's see here. So yeah, pound dollar shorts also very intact in my view. The pound isn't really rectified. Oh, sorry, the UK government, the Bank of England, so far hasn't really rectified the situation on the pound. We've had some stabilization as inflation came out cooler, which was actually quite supportive for the pound. But the core problems aren't really fixed. In fact, they're not fixed. So I'm still short, or still looking to short the pound. That's where I swing into 1.2. So 1.2 is currently the target that most, or currently the target that I've seen institutions talking about. That's where they're looking for pound dollar to go in the short term. So I'm not going to fight that. Again, the fundamentals support that idea. We've got a relatively stronger dollar, although we could see some cool down on the dollar, but if we look at it in a relative view compared to the pound, it's still significantly better to go long on. And again, the pound situation isn't really getting rectified. We are seeing a move to the downside on the gilts, which is so far quite good, but it's not enough really to support the pound in terms of giving it much strength to start outperforming the US dollar. Also, actually, there's another thing I want to show you is this report here from Citi. So this is a short thesis or a short signal, I guess you could call it. So a seagull, and Nick might be able to, or I think Chris is on after me actually. So Chris or Nick might be able to give you a better outlook on what a seagull actually is, because I don't trade this style. I think it's an option strategy. So when you are in a seagull trade, essentially you are going long twice, going short once, or vice versa to offset risk. Please don't quote me on that. Again, I don't trade options, but that's from what I understand. So they're currently short on euro pound with a 1 month seagull, buying and also selling. So that, again, basically what a seagull is from what I understand. So essentially they're just selling off this moving average and off this level. I can't make this image larger, unfortunately. Actually, here. So what you can see, they're currently selling off this moving average. Bearing in mind, according to the ICT guys, moving average is a retail. Institutions use order blocks, liquidity sweeps, and all that stuff on the 1 minute time frame. But anyway, we've got moving average. We've got a pretty nice level of resistance here that they're looking at as well. So this is a nice confluence, although it's not really backed up by fundamentals. They've taken it actually purely on price action, which is interesting because there's no talk of fundamentals or anything. They basically say, if resistance is broken, we'll take the loss, which is quite amusing. But yeah, Royal Trades, the PDFs are in our Discord, in the Elite Traders Discord. We send them out every day. Sometimes they're absolutely useless. Well, not useless, but sometimes they're a bit uninsightful. But sometimes you get some golden nuggets in there, so they're quite useful to read. But yeah, we send them into our Discord for our members every weekday. I'm still, by the way, in the Trump meme coins. So I'm in the Trump one and the Melina, both of those currently losing money. So that's nice. Pound to 1.25. Yes, I agree. I think 1.25, then yeah, down to 1.2, I would say. But yeah, I'm under the impression that the euro dollar upside pressure that we've seen recently is coming to an end. And I might be completely wrong. We might break out and continue higher, but just from the way the market looks and feels at the moment, we've kind of run out of that bullish steam that we were seeing drive this market up. So as you see, we were having really strong moves. This was actually due to tariffs from Trump when he said that there's not any immediate tariffs coming in, I think. Fairly sure that's what was said. But we were seeing these really strong, aggressive, bullish candles come in, which seem to be slowing down now. We haven't had any in the past 8 hours or 6.5 hours. So that's something, at least. So we'll see how this market develops. But so far, it still looks pretty valid for shorts. New Zealand dollar also. We've got the New Zealand dollar taking a real hit from China, or due to the situation China's in. So I would be continuing to look for shorts here as well. In terms of targets, now we've got two situations here, really. So I would, again, more lean towards the bearish idea on New Zealand dollar, where we continue down, benefiting from the dollar strength and the weakness in China that's also impacting the New Zealand dollar. So this might be a good place to go short. But then again, you know, we could come back down, retest, and then continue higher. But again, the downside is more favorable in my idea, or in my head. Targets would be this previous daily low back from 2009. That's the only level of structure that's sort of pointing out to me. And I think that's probably the only realistic area if we can continue down. I mean, this is a huge move, actually, if we do get this. This would be another 9.5% down on top of an already 12.5% drop. So that'd be a over 20% downside move on New Zealand US dollar, which is excessive. So I'm not hoping out for this trade, put it that way, but it does seem like the easiest way for the market. So yeah, I mean, that's basically it, to be honest. I'm sitting pretty flat because obviously I'm waiting for my current positions to play out. I'm not in a position really to be looking for anything else. Euro USD is a ECB press conference in 2 minutes. That's very true, actually. I'm on my last minute of my segment here. But yeah, you are completely right. So should be paying attention to that. Let me just pull this up. Actually, can't see it. Hold on. Oh yeah, okay. Here we go. So yeah, we do have that speech. So pay attention to what's said there. I'll need to go and watch it, of course, as well. I don't think I've got time to analyze a completely new market, but dollar Swiss is one I'm currently in here. So this one did take a hit, obviously, when we saw the downside on the dollar, but I'm still pretty confident in it. Although the Swiss doesn't really seem to be doing much on its own, so that's why we've paired it with the US dollar to basically just benefit from US dollar strength. We still remain in this uptrend. Obviously, we've got these moving averages that are helping us to identify this very simply. So yeah, downside move due to dollar weakness, but overall, I'm still pretty confident that we are going to see this trade play out over some time. It might take a while, but it's basically the only swing trade I'm in at the moment, as well as euro pound and euro dollar. So yeah, we'll see. Crypto, seems like I'm actually sitting in a bit of profit on Bitcoin. Yeah, these markets are actually moving really nicely. We've broken 100K on Bitcoin. Ethereum, not doing very much. XRP is moving really, really well also. Okay, cool. Wasn't really paying attention there. Yeah, no problem. Yeah, there's not much going on with dollar Swiss, to be fair. It's from our side, we're purely playing on just the dollar strength rather than anything to do with the Swiss. How many accounts do you manage and what would capital split? Okay, that's a pretty simple one. So Alex, I have 2 active trading accounts. So I've got one that's very low capital that I use for sort of public trading, if you will. It's one I do my live streams on. It's the one that I show trades on. And I've got another one that I keep completely private. And that one is where I keep the majority of my funds. So the small account's got about 10K in it. The private account is mid to low six figures. But that's not just my capital. I also have some private investor capital in there as well, which is why I don't make it public. No prop firms, nothing like that. I've got investment accounts as well, but obviously that's not active trading. They're just long-term investments in the S&P and things. That's more aimed towards retirement and, if I want to get into property one day or something, I'm building long-term funds in there. Yeah, no problem. But yeah, I think, to be honest, if you trade more than one strategy, you should have more than one portfolio anyway, really, which is something I didn't do, which I am considering to do. And the reason is, if you trade, for example, day trading, and you also swing trade, the stats get very messed up. And over time, it can be quite difficult to work out which strategy is actually performing better, which one is bringing down performance, what the Sharpe ratio is of each strategy, that type of thing, which really should track in the long term. So having multiple portfolios generally is a better idea. And obviously for different assets, obviously if you've got a CFD account, you might not be able to trade stocks. You might not be able to trade the, exotic commodities, if you will, like architectural commodities, that type of thing. But anyway, let me just check the time. So 10:15. Okay, so next person on is Chris. So Chris should be coming to take over at some point soon. Until then, you've got me. So if there's any questions, let me know. If not, I'm quite happy to sit and find something else to ramble about. In terms of the yen, again, it's not something I'm super interested in right now. We did see the break. Well, actually, this isn't really a trend line. This is more just gauging direction. But it looks like currently we're pricing in, or currently creating this lower high on this downtrend, which is one reason I wasn't very interested in going long on the yen. I know there's quite a lot of people that have been buying the yen, going short on pound yen, dollar yen, things like that. And it looked good, but I just wasn't convinced really that this is the end. Obviously, we do have quite a high likelihood of a rate cut, but we've also got a quite high likelihood of an intervention coming. So we do have two pretty positive factors. Obviously, we don't have any guarantees of either just yet. So once we have the rate hike, maybe my opinion will start to change. But I would be looking for this pre-intervention level back in July to get hit, and then maybe I'll be interested in going long, because that would be a sign to me that the Ministry of Finance or the MOF is ready to start getting into intervention mode. Just quickly, continuing the intervention talk, dollar yen is coming back up to approach 160. Now, I've been talking about 160 for a while, and the reason is because 160 is currently where institutions are looking for this intervention to happen. I'm not convinced that it's going to be 160 on the dot. I would highly doubt that that's going to be the case. I think that would be too easy to interpret, too easy for people to make money off. So I would be looking actually for a break of 160 to the upside and looking for anywhere within this range from 160 to 165. And then I would start expecting the intervention. Until then, in my view, there is absolutely nothing to do. So, guys, Chris is currently here to take over the show. So please don't leave when I leave. You've got more information coming. Guys, thank you for having me as always. It's been a pleasure. I'll see you later. Have a good day, and don't get margin called.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Good morning, everybody. Happy Wednesday. So, little discussion around this current price. last week I closed out some of my bull put spreads in the 600s on the SPY for a small loss. I saved some risk on it. I think I saved myself maybe 30 cents a risk, 35 cents a risk. It was a 2 to 3% probability of coming back to this level as of last week's trading. Because you look back a week ago, where were we? We were all the way down here, and this market has screamed to the upside. Now, I did place a trade this morning. If you are interested, which I could post this in the poll alerts, it is a bit of a fancy trade, but I am looking at something out 30 days for a little bit of income and a potential profit trap. So it's on the SPX, and I bought the 6290, sold the 6300 call. That creates a bull call spread. And then I sold the 6340 and then bought the 6375 to create a bear call spread. So I have a profit trap up here. It's out of the money. If I show you on the risk graph right now, it is looking like, let's float this back here. Looks like this. So right now this is trading for about $1.30 to $1.40 credit. Now the way this trade works is this is live price. So for about $1.40 credit, if price just stays where it is over the next 30 days, price can go up a little bit. Okay. Price can go down a little bit. Price can go down a lot. Price can go nowhere. And you can keep that $1.30 to $1.40 credit. So this entire area here is about $1.40 credit. Now this profit trap is if we're greater than 6,300, we have a $10 profit trap. So this would be 10 plus the $1.40 that you pull in for credit. Let me go back here. So 10 plus the $1.40. Right? So that'd be a max of $11.40 max profit. Now the risk on this trade would be if we're greater than 63.75. 63.75 is where I start taking on some risk. Okay. So I'll post the trade right now, showing $1.40 to $1.60. If you get, I got filled for $1.25, so you might actually get a better fill than me if you want the trade. There is risk in this trade. There's still a risk of about $2,300. There's a profit trap potential of about $1,100 is like the perfect trade. So it's either going to be I make $1.25, okay, I make $1,000, or I can get this perfect trade at $11.25, or worst case is I lose about $23.75. That's worst case. So I have quite a bit of number of ways to do it. I've got about a 90% chance of profit on the trade mechanically right now. The reason I decided to do this trade is, look, we've had a pretty amazing run, but if we don't have a 10% move, okay, we'd have to essentially look at this and say from the January 13th low, this market has gone up 10 freaking percent, right? That is a 9% move to get to my bull trap. And this would be, in order to threaten my position, we'd have to go up 9.8%. I mean, I'm not saying it's impossible, but I'm saying it's unlikely. So that's the trade that I'm taking. All right. Also, if you took the trade with me yesterday in the poll alerts for Netflix, Netflix just absolutely destroyed earnings, and we have 2 more days in the trade. Now, I need Netflix to stay above 920, and so I put in a pending order today on Netflix to close it. I'm not taking less than like 490 or 495 on the trade. Right now it's trading for about 475, 480. It was up to $5 earlier. I'm going to go ahead and put in a 4.90 credit today. If it fills today, awesome. I'll take, all but 10 cents of the trade, and we might just require the day to close out. But Netflix was well above expected moves. I calculated out about a 10% move, which past earnings did about 6 out of 10 times. So I had forecasted about an $85 to $86 move. I priced that in with my bull call spread and my bear put spread, and so I'm losing on the bear put spread. So I'm losing on the bear put spread, but I'm winning on the bull call spread, and the net profit should be around. I took this trade for $275, which means my max profit's going to be about $225. So I can lose on one trade and win on the other trade and still walk away with 225 credit per or for the trade itself, which is not bad, right? Trading the earnings play both sides and still walk away with a nice return on capital. Worse, my max risk would be 275. If I was dead wrong, 275 is my max risk, but to make 225 out of 275, I'm making 81.8% return on risk. It's not bad. Now, I obviously need price to, hang in there and just not collapse down to 920. So I'll go ahead and set a chart alarm here. This is by Friday, by the way. So 920 expiration. But I don't want to close this trade out for anything less than, well, I mean, I'll say this. I'm not going to let it turn into a losing trade. I will say that. But I'm going to try to get this trade closed out for like 490 or 495 credit to take as much of the profit as I can. Because right now the probability of us coming down, if I go to the expected move here, there's only about a 10% chance that price would come back down to 920. Okay. So I like the probabilities. I don't want to close it out right now and say like, oh, I'll just take my, 450 or 460. It's like, I'm going to try to get 485 or 490 for the trade and let it close today. If it closes out, I'll update the pulver alerts. All right. So that's notable on Netflix, way over expected moves. What this does tell me as well is if the market is excited about something, man, they're throwing a bunch of money at it. So if we have like, let's say when we have Mag 7 earnings that are probably coming up in the next week or two, if the market is liking the beat on earnings, so it's EPS or revenue, if it's liking whatever the consensus is, then we could have better than expected moves. So it wouldn't surprise me, but I also think that with this bar count on Netflix, I don't know. I don't want to call the top here, but I wouldn't be surprised if we fade this move. The stretch away again, like this is a lot away from the 200 moving average. It's 26% away from it, and it's also bar count wise about 320 bars from the last time we touched it. So anyway, we'll see what happens. We will see what happens. All right. So that is Netflix. Okay. For the week so far, let me go back down to the 5-minute time frame. A lot of gaps in the last week of trading. We've had 8 days of trading and we've had 4 pretty sizable gaps. So this was our CPI gap right there. Shortly after that, we created another gap. Even yesterday's gap didn't get filled. So there's still a gap there. And then another one that gapped up about 0.48 to 0.5%. I'm just thinking as we approach these all-time highs, we could see some resistance at those all-time highs. It's been a nice little recovery, obviously, but only having a 5 to 6% pullback on the S&P, a 7% pullback on the NASDAQ, if that's it, I don't think that's enough. I don't think that's enough to justify full-on buying spree. I think that, yes, a rotation out of Mag 7 and elsewhere is helping. The way that price has gotten back to these highs has been pretty inefficiently. So I don't know. I'm just a little skeptical. Am I calling the top? No, but I'm just a little skeptical to think that we have some resistance here. But there's clearly some renewed optimism going on this week, and Trump stepping into the office. Be prepared to hear from him every single day, for better for worse. And we'll see if this market is just like crazy optimistic. But I have my doubts. I think that if we take a look across the board, do our top down, 0.6% on the S&P, we're up over 1% on the NASDAQ. The Dow is, again, fractionally up. It's up about 0.25%. Russell is down. So we have the growth, right? So the top 200 growth on Russell is up 1.4%. That is pretty much matching the NASDAQ, but your IWM is down 0.5%, and your value is down 0.3%. VIX is getting suppressed once again. Let me just go back to SPX here. VIX is down. So VIX is down to 1492. I suppose if the VIX is going to continue to push lower, if VIX pushes lower, then we probably have the market melting up a little bit higher. SPXY Still making its way back up. I'm just going to keep an eye on this. If we have any type of like correction, I'm just going to end up buying or putting on some option trades in SPXY. DXY, decent pullback. I'm gonna look at the comparison between the DXY and the 10-year yield. Oil still fading a little bit. Possibly support on oil at the 200 moving average around 74.20. Watch for potential bounce here. So if we can bounce off that 200 and look for a closing candle, there might be a nice little scalp opportunity to get back to these highs. Oil is going to be a really big factor on inflation with energy prices this year. Natural gas, same thing. So, watching these closely. My UNG position is, out in time, not worried about it. I'm trying to see if we get into the 20s. Gold having another, I mean, honestly, it's a great week on gold. So far, gold for the last how many weeks? 1, 2, 3, 4 weeks in a row, we've had a nice little surge on gold. So from the lows around 25.95 to current price, we're up around 6% on gold for the year so far. That would be end of December into the first part. Yeah, we're up about 5 or 6% year to date on gold. Not too shabby. I still like gold longer term. I just didn't get the deep enough pullback to buy where I wanted to buy. So I'm just maintaining the core position that I had last year and carrying that into this year. If there's any range trade, I keep mentioning this, coming back to this level here, finding some resistance. If this is a range trade, I'd be happy to establish, more core positions. I'd be happy to establish some out of the money option plays on gold, but I'd still be looking to edge higher. Okay, silver has actually been lagging. If you look at gold versus silver, so gold is up to some recent highs the last four days of trading, the last 4 weeks of trading as well. Silver is not quite there yet. I want to see if silver can get back to 32.25. If you look at gold versus silver, we're seeing this push back up towards these highs. Now, one thing that would be kind of nice to see, just based on this range, this is gold compared to silver, would be that we run into some resistance here and we see this head back lower. I'd like to see silver get the upper hand, at least from this chart, and see if my silver trade can catch up and gold can still maintain bid. But I still like both gold and silver to the upside for 2025. Bitcoin, bit of a pullback after the poke of the highs at 109. Possibly a range trade. Maybe some more accumulation happening in this area. So if this is a nice little bull run through the election, a wave or flat pattern where we can find some equal lows, I wouldn't mind getting some pullbacks into I'll just say 90K. I mean, if we're close to 90K, that's at least like position one to scale back in. If it ends up falling back down into deeper corrective levels, that's okay. I'd still be buying this thing around the 80 to 70K level as well. So a couple of dollar cost average spots, but I'm going to be patient. Look, I have ownership of BITO, ownership of IBIT, ownership of FBTC, ownership of MicroStrategy. If we're going higher, there's plenty of profits that I could roll with. What I'm looking for is if I want to add to any positions or generate some income trades, I've got to be patient on my technical levels. Okay, but that is just me. What else? MicroStrategy down slightly to 380. I still have my covered calls in to 310, and that's out into March. I might consider doing some additional rolls on this one. When I'm within maybe 20 days of expiration, I might look at another roll and keep the same strikes. Maybe go out another 2 to 4 weeks. If I can keep rolling this thing for $2 to $4 at a time is pretty solid. That just keeps adding to my bottom line. Coinbase is up slightly. I did some income trades on Coinbase. Actually, I wrote this one down yesterday. Let me see here. Lots of notes on the old scribble pad. Trades this week: Netflix, Apple, Google, Microsoft, Tesla, Costco. Let's take a look. I'm gonna look at Apple. Okay, so Apple, IV rank, we're down to the 200 moving average. Now, I think this is a spot that I could probably put on a trade for Apple, similar to what I did here. Okay, I don't mind taking some ownership of this trade, but that would be Apple having to drop all the way back down to $200. Okay, is it possible? Sure. Apple could drop, 24%. I take on some shares. What I'm going to look at right now is the IV rank has to be high enough that I could probably put in an income trade. And let's go out. I don't mind this like 58 day. This is March 21st, which is a similar expiration to this one. All right. So I'm going to look at the same expiration, but I think I could do a ratio spread and go further down than the 210 by 205. Okay. Question comes in: if inflation sees another high, how does it move the market? I mean, inflation. Look, gold is going to be a hedge regardless. If you see like dollar debasing, loss of purchasing power, You see geopolitical tension. But look, gold is a pretty solid play regardless. Bitcoin is that like new anti-dollar trade. It's it's speculation and it's risk on. I think that's the one thing that most people aren't looking at with Bitcoin is they just think it's this digital asset that exists and it's its own island and it's going to be better than everything else that exists. I don't think that's a play. I think that Bitcoin is still risk capital. You need to have some risk appetite. You need to have some optimism and animal spirits, and then Bitcoin is fine. But the amount of like inflows and outflows, when we go into negative times, when the market starts to dip and pull back, you really don't see Bitcoin up. So I think gold is still a good play. I like silver because technically I can still measure new moves to the upside. I think both those plays are pretty solid. Central banks are bidding like crazy to stay into gold and accumulating more. I would rather be in gold spot price than I would be in miners. I don't care about miners. I think their balance sheet and the growth you'd get on their stock price and appreciation would be minimal compared to just the spot price of gold. But I mean, we'll see what happens with inflation. The PCE numbers coming out at the end of the month. So we have the Fed on the 29th, and that's a Wednesday, and then Friday we have PCE for the US. And all of it is pointing higher, right? Same thing with PPI and CPI, and the last 3 months of inflation prints, we've seen higher levels. The market got all excited last week because it's like, oh, it was less than expected, right? But it's greater than previous. So we're still seeing higher inflation readings. And I think in the near term, it's still going to stay that way. So anyway, let me look at a trade here. So March 21st is out 58 days. I kind of like that window. Let me see. I should be able to go lower. If I did a ratio spread around the 190 by 185, see what this looks like. 57 cents. Okay, so I can move this strike down. This is a what? A 210 by 205. And I can move this now to about an 88% chance of profit, about a 9 to 10% chance of assignment. I think I'm going to take this ratio spread for $200. So I'm actually I flipped this around. My bad. That's an out of the money. That's not bad actually. I mean, just a credit spread for crying out loud. So if I sell the 195, buy the 190, I get $2 for the trade. That's pretty solid. Let me see what this looks like if I flip this around. If I buy the 195, sell the 190, and do that times 2. So I make less credit on I make less credit on a ratio spread than I would on just an out of the money credit spread. Is that right? No. Okay, never mind. Never mind. Wow, the ratio spread is really terrible. So if I buy the 195, sell the 190 times 2, 72 cents credit. Maybe that trade. A 111 for 44 cents to take on 200 shares. Nope. How is Apple's premium not better than 45 cents on like a naked call? That's crazy, or a naked put. That is garbage. How about I don't want to do a broken wing butterfly because I was thinking a broken wing butterfly if I could get premium for it, but I want to have a profit trap. There's just no plan B on that trade. There'd be risk on the trade. Let me see if I did a butterfly long put. Where would I pin this thing? I could pin this thing around the 190. I don't know. So if I go 10 by 20, still not good. Hmm. 94% chance of profit trap, but only making like $40. Gosh darn it, man. Well, I guess I got it at the right time. I don't know. I'm surprised like the IV has increased. Is this a spot to buy Apple? That is let's say that's the $3.3 trillion question. Well, if I did a ratio spread, I want the assignment. I mean, it's like if I do a ratio spread, I've got to be willing to have an assignment price. And from there, the plan B is I just repair it. If I do a ratio spread, so if I do a ratio spread, so plan A, okay, so plan A, I feel like Buzz in New York, Home Alone. I'm like A, 2, C. Plan A would be credit on ratio spread. Plan B would be assignment and repair the trade for profit. That's it. So I have a backup plan. I've got the capital. I'd be willing to own the shares, and I just repair it for a $5 or $10 net profit. Try to make 500 to 1,000 bucks. So I like to look at those as like if I can flip it for half of 1% to 1% for the portfolio. I can do that, whatever, 10, 15, 20 times a year, and do okay. Right. But in order to get that assignment repair, I also have to make sure that I'm, protecting the downside and still watching the income levels closely. All right. So unfortunately, I'm not getting the implied volatility is high. I mean, the Ivy rank in Apple is decent, but I'm not thoroughly impressed with the dollar amount. So if I did another 200 by 195, do I get more money? I get less money on this ratio spread than I did when I already took the trade before, which is crazy to me. So I suppose what I should do is look at another expiration. How about I just do that? Let's go out another expiration to April. Maybe it's a little bit better now. If I did a 10 delta, so I can buy the 185, sell the 180, move these strikes up. Okay, this one's a little bit better. That's way different. So if gosh darn it, I got it backwards again. I swear I did that right. If I buy the 190, sell the 185, there. All right, so that's one way to do it. I could buy the 195, sell the 190 2 times. So that'd give me a 125 credit with a profit trap. Ratio spread, if price is somehow not below, this is a 11 delta. So I get 97 cents on this trade with about a 95% chance of profit. I get $1.26 on this trade with a 93% chance of profit. Max loss, I'm going to take on the assignment if I do this trade for April. If I'm getting like somewhat, I'm not going to say aggressive, but if I'm getting somewhat optimistic for this part of trading in 2025, I would say my optimism would maybe go into March or May of this year. The first half of the year, I'd say, okay, if the market shrugs off a lot of bad stuff and it's just kind of floating on optimism and momentum from last year, great. I still wonder, like, Q4 earnings could print in Q1 and still show some optimism. There could be whatever. We could just have more optimism now that, okay, Trump is president. Everyone's stoked that he's president. Businesses are optimistic, probably to a fault. And the realities of the Trump administration, we don't know. We don't know if it's 25% tariffs in Mexico and Canada are good or bad. It's going to be inflationary. It's probably going to be global friction. Can't be that awesome, right? Now, I don't know how this all plays out, and it could be a lot of talk versus all bark, no bite type thing. So who knows? But for this particular trade, would I mind having Apple on sale with an ownership price of 185? So if I took on shares 190 minus 5 minus 125, I'd own shares at 183.75. Okay, 183.75 on Apple. Let me see if that's worth it. So 183.75 would be around a 30% discount. I mean, cash flow wise, I think Apple will be okay. That pulls me back into these previous resistance levels. I don't mind the trade. If there's a pattern here where Apple is taking out lows, getting below the 200 moving average, if there's any dead cat bounce, that still should give me a profit on the ratio spread. If I take on shares coming back into 2023, 2024 lows, 2022 was a little bit worse for wear. So point is, do I want to own a ton of Apple. No, I would say 1 to 200 shares at most, and I'd be looking to repair it. Like I said, for half to 1% repair is fine. So if I go out to April, 190, 195, get a $1.20 to a $1.25, not a bad trade. I'm going to take this trade for my portfolio margin accounts. Yeah, let's do that. Portfolio margin. Okay. So 124. See if I can get filled for 124. $124 not filling. Let's try 123. I will accept no less than 120. 121 is the freaking bid price, man. Come on. 121 got filled. All right. So that trades in. Filled at 121 and filled at 121. Come on. $121 pending. I'm below the mid price. Let's go. 120. Fine. 120. All right. So 121 is the fill on two of my accounts, 120 on another. So I'm going to track the 120. So Apple ratio spread. So a 417 expiration. Buy the 195 put, sell the 190 put, $1.20 credit, willing to own, break even on ownership. If I take the assignment, would be 190 minus 5 minus $1.21. So it'd be $1.79, I believe. Yep, 183.71, or sorry, 79. All right, I'll get that added into my pulver alerts. That's going into stock options trades. New trade, Apple. So a 417 expiration. Buy the 195 and sell the 190 put. $120 credit. Willing to own Apple shares to repair for profit. I'm going to try to get, $5 to $10 net profit or better. On this trade all by itself, it's a 93% chance of profit. And with the 190 put at a 11 delta, I've got about a 10 to 11% chance of assignment. If assigned, Apple price needs to be less than 190 by expiration. The break even on ownership is 183.79. Is that right? 183.79. That is correct. Okay. Good there. All right, that's it. Apple, I'll add this in, 417. Here it is on the chart. 417 expiration. Buy the 195. Sell the 190. $1.20 credit. So screenshot in. And there we go. Okay, close out some profit this morning. This is a service that I run 44 out of 48 have been winners the last couple of months. Looking solid there. I do want to close out a couple more of these trades. So the last one I did was a QQQ and the SPY. So I closed out one. Some of these got filled already. Let me double check. SPY, I've got a 599. It's this one here. So 597, 596. That one's got to be really close for profit. Let me double check that one. This one is only 1 cent off the 99 by 98. I'm going to close this one down for a, hopefully a winner here. Come on, dude. Okay, so that 599 by 598 closing out 599 by 98. Okay. And then the 97 by 96. These are all out of the money, out of the money. These should all be good. Okay, so this one I'm going to close. This one be just like full profit or close to it. 20 cents. Yep, I'll close this one down for 20 cents. 21, 22 cents. 21. All right, that was a 597 by 596. So 28-cent debit there, and then 20 to 21 cents on the 597 by 596. So taking two little winners there. And to the Qs, 515 by 520 closed, the 520 by 525 taking profit in this one. 362. Let's try that one. 362 here. 361 right below that mid price. Hopefully, actually 363 is the mid. 362. 361. All right, just doing some maintenance here, grabbing a couple of bucks. $360. Okay, what else on the Qs? The 515 by 520 close for profit. 520 by 525 close for profit. The 510 by 515 close for profit. The other ones are fine as is. Okay, those are fine. All right, so I need to go through and close out some of these trades. So let's go to the SPY. The 599 by 598. Close for 26 cents. Very good. What else? The 97.96 right there. Oops. Son of a biscuit. 97.96 closing for hopefully 20 cents or 21 cents. 20 cents. 21 should fill. Perfect. Okay, that should take care of all my SPY trades there. So this is going to be some just account stuff on my end. One winner, two winners. Rest are condors above and below. The QQQ trades, 515, 520 closed, 520 and 525 closing now. This one hopefully will close for 360. Come on. Closed out there. And that should be it. 515, 520 closed, 520, 525 closed, 510, 515 closed. That's three winners on the Qs. Very good. So the 515 by 520, the 510 by 515 closed, and the 520 by 525 25 closed. So that is 5 winners closed out right now. I've got to do this on all my accounts. So I'm going to get these knocked out really quickly. I just need a couple minutes to update. Closed out there. Close, close, and close on Qs. Easy peasy. The 97.96 right here, closing out for 20 to 21 cents. Ooh, 20 cents. Give me that mid price. Nope. 21 cents should be filled. Come on, mid price. Profit. Okay, close out there. The rest should be okay. This one, 26 cents. 27. Close to 26. Okay, good. So that is 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Yep. All right, good. Okay, a couple more. Just let me get through this, and we'll keep going top down, try to find some trades. I put in the Apple ratio spread. It's posted in Pulver Alerts. Netflix is looking good for full profit for tomorrow or for Friday. I'm trying to close it out right now at 495 or 490 if I want to take the trade early instead of waiting for a $5 close on end of day Friday. So this trade can close out for 21 cents. There we go. And the 98.99, close this one out for 26. Come on now. Profit there. Okay, helps clean up some of this activity, which is nice. Let's go Qs now. Closed out there, 520, 525. This one, try to get out of here for 360. Come on. Mid price 359. Let's go. 57 filled. All right, 510, 515, done. 515, 520, done. 520, 525, done. Good. All right, 1, 2, 3. Got a little bit more work to do, but let's get it over. Let's get it over with. 359. This is the fun part about individual accounts, is going in and making sure that everybody's getting the trade open and everybody's getting the trade closed. So it just takes a minute, but want to book these profits. That's 3 trades on the Qs, 1, 2, and 3. Good. Now to the SPY, the 96.97. That one should be good for 21 cents. Don't you get sneaky on me with that extra penny. 21 filled, no problem. Good. And this one closing at 26, hopefully. Filled. All right. Home stretch. Okay. And this one here. Good. And then Qs. See if we can get out here for 359. Filled 358. Okie dokie. Filled. That's 3 trades on the Qs. Good. Now SPY. This one can close out for 21. I mean, come on. Closing at the freaking ask price. Awful. And this last one here. Closed. All right. Okay, 2 more counts and we'll move on, but want to get these trades tightened up. Closing there. And this one. Good. Now Qs. 520. Closing. And that's 1, 2, 3 closers. Good. So that SPYs and Qs there. Very nice. Last one. Closed. 1, 2, 3 on the Qs. SPY. Let's go 27 here. Filled. And this one for profit. 21. Okay, that should be all accounts. So 597, 596 closed for profit. The 599, 598 closed for profit. The Qs had 3 trades closed for profit. So that's 5 winners. And my little screenshot here, this should be 45 for 49. So I can just delete that. Let's go 45 for 49. Not too shabby. Don't mind a win streak. Okay, let's go find some trades. Okay, that made life pretty easy. That 97.96, close that one out for 21. So that is 12.67. Nice. All right, now we're cooking with gas. Tracker's getting a big fat update. There we go. Cool. All right. We're good. Let's keep going. Apple, place a trade for April. It's in Pulver Alerts. Amazon, new highs. Ooh, let me look at Amazon here. So I'm going to log into Thinkorswim. I've got a covered call up to 220 out to March. I'm going to look at a quick roll. And see if I can just roll out a collar trade. Oh, man. There we go. Okay. Let's go Thinkorswim Web. Okay, so sitting on Amazon. So I have shares put covered. Um, let's see. I think I could just close out the put and eat this and then look to roll this covered call if possible. Let's see if I can roll this position. So can I roll this? Do we have any other expirations between March and April? It doesn't look like we do. So that's frustrating. But if I roll it, keep it the same strike, 230. So I could get some premium for this for another couple of bucks, which I'm okay with. I'm certainly not going to roll it for a debit. That's silly. So I should get another $2 out of this roll. If I roll it up and strike, it's going to ask me to pay for it. So to go up $5 in profit, I'm going to have to pay $1, probably maybe $1.40 for that, maybe $1.20. So I'm better off if I just roll it out and try to get another $2 out of this. So can I roll this for like a 210? Let's find out. So if I roll this for 210, and I probably want to trade something inexpensive put-wise, I'm going to get 210 for this roll. So that'd be another $417 of credit. Let's see. Still working. So mark is 210. That's what I'm trying to get filled at. 207. Let me edit this trade. Let's try to get 205. All right, filled the 205. So I just did a roll on Amazon. I didn't roll it up in price. I just roll it out in time, and then I will play around with another long put. I'm going to see what April and change looks like for a cheap in the money or cheap out of the money. So option chain. Let's go to March, April. Let's go to April. Let's buy something pretty cheap. I'm just going to put like an outlier one. So 125 is going to cost me. I'm going to sacrifice $100 on this. I'm going to go 125. See if I can get filled here for 10 cents. It's going to send me back $100, but it's hedged for an out of the money put. Filled. All right. So Amazon's protected now. That's good. Position wise, pretty simple portfolio. Amazon want to cover. Got some Bitcoin exposure. Got some uranium. Got some aluminum. Have some China. Have some Amazon. That's about it. All right. Want to handle that one really quickly. Do I like Amazon to do anything on it right now? No. I'm managing the shares that I have. We have still had a pretty good stretch away move. So from our current price down to this 200 moving average, that's a pretty decent stretch. We've had, it's not a high bar count, so I'm not, necessarily like calling the top. But Amazon is performing pretty darn well compared to others, right? I mean, Apple is down quite a bit. Apple's down about 15%. Amazon's up to fresh highs. Google is still lingering around these fresh highs. I'm staggered out here with Google trades. This one closed out for profit. Those are still running to 2025. Got some ratio spreads and income trades on Google. I'm totally fine with this one for right now. Meta is lingering around all-time highs. This one has a crazy high bar count. I'm going to wait for a dip. If we get a dip on Meta, I'll probably put in some income trades. If it goes higher, I'm not going to chase it outside of the dollar cost average positions that I already have. but I think we're going to find this 200 moving average somewhat soon. Microsoft is still, I mean, it's behaving nicely, and I've got January. This one is done, so that was profit. Now I have February and March. Because we just ripped to the upside off of this V, kind of V bottom off the 200 moving average, I'm not going to place another trade. I like taking these trades when the market is dropping like this. I put in these trades. So if Microsoft comes back down, then I'll probably put in a trade for April expiration. That'll be a 421, and maybe a May, and just see if it holds that support level. So I'll wait on that one. Netflix, went all the way up to $1,000. I need to stay above 920. I'm going to see if I can close it out. I'll see where it's at by the end of the day. If I can close out Netflix for, I don't know, 480, 485 would be acceptable. I'm trying to make at least $200 per contract. That's the plan. NVIDIA, up to 145. I might actually be able to squeeze a roll out of this. Let me find out. Take a look here on NVIDIA. So NVIDIA has some shares, got a collar. There's my share price. There is I'm looking to see where my March 21st, 140 by 130. Okay. Oops. So this is a collar trade. I own the shares at I'm trying to think of my break even. Let me find out. It's like 134, something like that. NVIDIA. I own the shares. That one's fine. Ratio spread was profitable. That one's fine. Okay, so I own the shares at 132.14. 132.14. So can I roll this? I want to see the expiration. March 8. Gosh darn, man. I don't have anything in between March and April. All right, well, I'm gonna roll it anyway. If I get a couple bucks for it, I'm gonna roll it. So let me see if I can do a roll on this. So if I roll it out for another 30 days, I get 65 cents more. That's really not worth the roll, in my opinion. I get it called away for $7.86 a share right now. If I roll it out for another 30 days, I'm only getting 65 cents on that. If I roll this down and up, this one wouldn't be awful. If I roll down the put to 125, I could get $2 on the trade. That actually is okay. So I can roll it out farther, keep the strike price at 140, roll the put down to 125. I know it takes a little bit off the protection side, but if I roll the strike out or down to 125, that gives me a $2 credit, which brings my cost basis down to 130, and then I get it called away for roughly $1,000. So I'm okay doing that. And then on the put side, I'll just track the debit price and still have that protection out to April. Okay, so I think I'm going to do this here. Let's go. Let's see what it looks like if I go out one more expiration. That's not that much. That's not better. If I roll it out to May, I get $1.27 for the same exact collar trade. I don't love that. I'll take this one to April. I'm just going to go like bit by bit. So that's adding another just under 30 days to the expiration that I currently have. I'll roll this strike down to 125. Now I get over $2 on the fill. So let's try to get this thing for hopefully $2 or better. I'm going to try 205. Filled at 206. All right, that was pretty straightforward. And I think I have shares of NVIDIA on 3 of my accounts. 1, 2, 3, 4, 5 accounts. Okay, well, let's try all those accounts then. There's my shares. There's my 130 by 140. And look for a roll. Roll this down, go out to April. I'm going to get 206. I'm going to go with 205. Filled there. NVIDIA 130, 140. Roll. Let's try to get 210 on this. Why not? Nope. Let's try 207 fill. 206. Filled at 206. This account, no shares of NVIDIA. This account has shares. There's my 140, 130. Roll down 207. Nice. Okay. And 140, 130. Roll this out. 207. Filled. NVIDIA, no exposure on this one. And this should be the last account for that trade. There's my. Okay, so let's check here on NVIDIA. 1, 2, 3, 4, 5 rolls. And of ownership, I have 1, 2, 3, 4, 5 accounts with shares. Okay, so I successfully rolled all the accounts that have ownership. I rolled out all of those trades. 206 is my minimum, and 207 is my top. So it's a decent roll. I'm going to add this and update my tracker here. That's the fun part. So update, roll out to April 17 expiration. 140 sell call and a 125 buy put, and that buy put debit would be a 420. And I did that for 206 credit. So new break even is just under or just over 130. So 132.14 minus 2.06, 130.08. Okay, so 130.08, if I get it called away at 140, I make 992 on the shares that I have, times 5. Nope. So what is that? 130.08 times there. So I'll make 49.60. All right, that's NVIDIA. Let's keep going. Tesla 422. I'm going to wait for Tesla. Lee, do you have the link for it? It's in my Discord. I've got the $27 starter course for the quick options, and I've got the full practical options. Also, if you purchase the Pulver Alerts through A1 Trading, or you purchase any of my lifetime services with Daily Profit Play or Waterfall Income or Double Up Alerts, if you purchase lifetime there, you can get the practical options course included. Just food for thought. All right, on Tesla. Look, I like Tesla. I have some shares. I'm going to buy some more shares. I'm still looking for income trades as well. This is a February-March income trade. It's basically, this is a 1-1-1. This is a ratio spread. That is okay. I think Tesla could still find its way up into these highs, but I wouldn't be surprised if we face some resistance. So what I'm going to look for is something like this. If we go high, low, lower high, lower low, I'm going to start adding additional income trades out of the money. I'll also dollar cost average into Tesla a little bit more. I'm pretty keen on this like 300 to like 275 area to buy some more shares. Okay, Maddie, that's awesome. Thanks, I appreciate that. Berkshire Hathaway 457. What, dude? Look at this nonsense. What is happening with this? Berkshire Hathaway's pilot unit to close international oil trading business. Lags industry in 6 months. Okay, well, what's Oxy doing? Son of a biscuit. Well, I got a 50 by 40 on OXY. If it stays above 50, I still make some bucks. If it stays below it, then I play around with it more. So I can make $1.37 per contract. I got 500 shares of OXY. The idea was just to repair it. If I end up, keeping the collar alive and well, and it doesn't get called away above 50 bucks, so be it. If it does get called away above 50 bucks, that's fine. So anyway, keep an eye on that one. I was just looking at Berkshire. That's crazy. That's a big move. And I don't know if that's an overreaction, but I would say on Berkshire, like, how ugly does this one get? I don't know. We do have a decent bar count. This is pretty similar to the S&P 500. Since October 2023, we've had a stretch move about 300 bars. Go back to the S&P, you're probably sitting at like 320 right now. and we're obviously quite a bit further ahead. 305 bars or something like that. So that seems to be a sensitive reaction to a stock that essentially has traded like the S&P. So I think what I will do on this one is not throw in another trade, but rather see how this one plays out. If I were to take any assignment or ownership, I will watch. There's still room for this trade. I mean, I'm not threatening on this position unless we drop all the way down here to 410. We'd have to do some real damage for Berkshire Hathaway to, number one, be about what is that, 16+% off the all-time highs, and from current price, we'd have to drop another, 10 to 11% in the next like 60 days. So we'll see. Let me check the IV rank really quickly. So Berkshire B, IV's at 21.7. Yeah, it's not really high enough for me to say I want to take another trade. When I took this trade originally, we were already sitting around the 200 moving average. That's why I put on the ratio spread. So I'm going to hold off on this one. I will set a chart alarm, though, at the 200 moving average. So 200 moving average. And if that gets hit, I'll look at the IV rank and see if it's worth maybe putting on another trade. Okay, let's take a look at bonds and yields. Okay, 10-year yield is up a little bit. So bonds, a little softer today, a little softer today, a little softer today. 1 to 3, 7 to 10, 20 plus. 10-year yield is sticky around 4.6. I don't know what's going to be. Look, I don't know what this is going to do, right? I mean, if this is a little bit of a inflation pop where inflation shows like, oh, everyone's optimistic and the market rips and the 10-year drops, I just don't know if there's going to be more direction to the downside, or if this is like, okay, nice try, there's a little relief, and then we're going right back up to the highs again. We will probably know more by the end of the month, because when PCE and core PCE comes in on the 31st, it's literally the end of the month. We're going to find out whether or not we're creeping up to that 5%. This is another thing too. I don't think the market can have a ton more upside if we are creeping up into 5% on the 10-year yield. Like that to me would be another kind of broken market, or on the verge of, the yields might lead and the equities might lag, but eventually they will catch up, and we probably won't have too much upside on the equities market if we're stretching out towards 5%. Now, that being said, if we do drop a little bit lower in the 10-year yield, then I could see that there's some more ammunition to justify equities going higher. But this is still like very sticky inflation for right now, as we've seen for the last couple of months. What else here? By the way, I have one trade in my portfolio that is bond exposure, and that's TLT. That is it. Everything else, as far as bond exposure, I'd rather own gold. I'd rather own silver. I'd rather diversify with Bitcoin, for crying out loud. I don't want to have bonds in my portfolio. TLT is fine. I'm trading a diagonal spread to 2027. I'm trying to give myself a big fat window to be right. And hopefully I will be. But it's something where, if it generates a couple grand and I make like 1% on the portfolio, like per account, that's fine. But I'm not looking for like a big bond exposure. If I were to diversify, I actually talked about this. I may be offering a course on this sooner than later, but I'm looking at a diversification of about 50% equities, and that'd be a split between S&P and NASDAQ. And I wouldn't mind going equal. If you want some equities exposure, I wouldn't mind going like 25% S&P, 25% NASDAQ, and then looking at like a 20% gold and silver, or actually a 25% gold and silver, and 25% Bitcoin. If that's too health or too high, then you can go 50 equities and maybe a 20% gold and a 20% silver and a 10% Bitcoin. So I've got some fresh accounts that I'm looking to open up, and this would be a really easy way to have, core positions with options around them. Obviously, if I get called away for profit, that's good. Build the bottom line up by maybe 1 to 2% a month, and continue to have defense and collars, and see if you can generate a 15 to 20% year on a lot of the retirement accounts that I'm looking at. Like, this is a pretty simple mix. And obviously Bitcoin is going to be volatile, for better for worse, but having protection would certainly help. I would almost rather say like I don't know. I mean, even if you had 10% exposure on Bitcoin, if Bitcoin rips, the whole portfolio is going to benefit. If Bitcoin is higher, I think that's still risk appetite. You're going to see equities probably drifting higher. Gold, silver be your bigger diversifier plays. Gold, historically, if you go back 70 years, instead of putting bonds in your portfolio, if you put gold in your portfolio, it's performed the same, if not better. So the whole idea of like the 60-40 portfolio, it's pretty trashy. I don't want bonds in my portfolio. Now, I don't mean to insult any bond trader out there that's just like, it's what I do. Bond yields are totally different than trading bonds. But anyway, I'm not sure. But I like that mix because it's pretty simple. It's easy to manage. It's easy to also have like, upside callaways and downside protection. Futures market. Corn's been making a nice little run. I've talked about this the last couple months. I'd like to see if I could trade corn futures, which I can on Tasty. Any type of pullback in here, I might look to get long on corn. I wanted to see if it would pull back into these 2020 and 2021 lows, but it did not. So now it looks like, okay, we broke this structure. We're now in a buy zone above the 200 moving average. I can't just buy the breakout. It's too high. I'd get positioned on option trades. So maybe looking at some type of crown pattern like that. And so a pullback to let's say 425, maybe looking for some follow through. Okay. It's not the dislike is mostly the potential risk. Let's say that the US market breaks bonds, right? Let's say that nobody wants US bonds anymore. Let's say that the fact that we print money into oblivion weakens the dollar, and it's just like you can't just keep kitchen sinking monetary policy and expecting it to be like everyone wants your debt. So I'm just saying at one point, like, what if the bond market breaks? What if there's so much stress in the bond market that it freaking breaks something? It's going to break equities just as much as it would break the bond market. But I don't know. I think, look, if I was going to own debt, I'd rather own a corporate bond for Apple that is sitting on, actual cash, as opposed to the government that's like, yeah, own our bonds. We're good for it. That's essentially what the U.S. government says. Backed by the faith of the U.S. government. We're good for it. Okay, well, what if they're not? And that's like a worst case scenario. But I'd rather not have to worry about the exposure. And I could say the same thing about Bitcoin. I could say, like, yeah, Bitcoin go to zero. Maybe it could, but that would not be a crazy allocation. A 40% allocation of bonds, and the bond market breaks, and we've been in a 4-year drawdown of bonds. That is exactly the reason I want zero exposure. I mean, the bond market's been trash when the equities market has been absolutely crushing it. So, we're at one of the highest correlations in history, where bonds to stocks are correlated like 0.73, which is really, really high. And it's going to break. Like, that correlation will not get higher. It should be getting lower. And then you wonder, like, which one gives back gains. If equities keeps improving, but bonds keep getting worse, then the correlation is more opposite. But anyway, I'm just going to minimize the bond exposure. That's all. I'll trade options on it. I'll pick some trades here and there, but I'm certainly not doing a 60-40. I don't want that much exposure in bonds. Soybeans, anything off the lows a little bit. Wheat, if we can settle back in here. Cocoa, still curious and watching. This one is diversified ETF. I don't mind this play. I'd like to see if we get back to 2250 before I get long. DBC, still kind of building some structure. This would be a great little falling wedge. If this keeps building and accumulating, I'd really like to look at a time breakout. And maybe that's not, for another 12 to 24 months, but on this trade alone, like, man, that'd be an excellent trade. Probably doesn't look good for inflation though, if I'm right on that trade. If I'm looking at these diversified commodity-based ETFs, this is not looking for inflation if these things are going higher. Jobless claims, initial claims, China down, JD at 39. I might get this one called away. When's my expiration on JD? I also have some shares. Let me take a quick peek here. So JD exposure. So I've got 3 accounts, 500 shares each, covered at 39, protected. Oh, shoot, this is next Friday. Let me take a look at a quick roll. Because I have 500 shares, if I roll it and I can get, 40 cents, 50 cents, that adds up a little bit. That's worth it. So if I do a 39 by 30 roll, I go out an extra week, keep the exact same strikes, I get 1 cent. Well, obviously that's not worth it. If I go out to the monthly expiration, Feb 21, we have earnings on March 5th. Okay. I might actually do this if I can roll this out into March. This might not be a bad play. So I've got all the way to March 5th expiration if I wanted to get some more time in the trade. Okay, let's go out to the 28th. So I could keep the 39 and I could keep the 30. That'd be my collar. I get it called away, grab another 92 cents at 500 contracts, or I'm sorry, 500 shares. So 0.92. I make another $460 on 3 accounts. I make another $13.80 bottom line, and I'm going out an extra 30 days. That's not a bad play. Also, that's pre-earnings. So if there's still some optimism in China, that's okay. If I increased it up to $40, now I get 45 cents on top of an extra $1 of profit. So I get another $1.45. So $1.45 times 500 times 3. So another $2,100. I'm going to go for I'm just going to keep the collar the same. So 39 by 30 out to Feb 28th, right before earnings. Oops. Yep. Because then I have to go out to March and I've got to take in earnings, whether it's good or bad. And earnings could be fine. They could be fine. And if I like the stock enough, then maybe I can just establish another position. So I'm going to roll JD. Where right now we've had a nice surge to the upside. If I keep it there, right now I've got a January 31st. I could get it called away right now with a break even of 36.82. But if I go out another 30 days, I roll this out to February 28th, keep the collar the same, and I would lower my cost basis down to like $35.90. Still get it called away at 39. I'll just make the extra like 90 to 92 cents per contract, which is not bad. Not bad at all. Okay, so I'm going to do that. Let's do this. 39 by 30 collar. Let's go back to Feb 28th. So let me see if I get 90 cents for this. 90 cents. Filled at 90 cents. Nice. That's not bad. Okay, no exposure there. Take the 39 by 30. Roll this out to the end of February. That was a buck. Hang on a second. What the fudge? 30 by 39 for 90 cents. I'm doing it on this account. It shows $1. Same expiration. Yeah. All right. Well, let's see if I can get a generous offer here. So let's go with buck on this one. Filled for $1. Well, that rolls way better. And this one has 0 JD exposure. Okay. This one has 0, 0, 0. This one has shares. So 39 by 30. Quick roll. Out to the 28th for $1. That's a big difference in fill. I'm kind of disappointed that one got filled for 90 cents. That one got filled for 99. All right, so let me update that in my tracker here. JD 36.82, and I'm going to take the lowest credit. So update. That is a 24-cent put, by the way. So update would be a roll out to 228 expiration, $39 sell call, $30 buy put. That buy put cost me 23 cents debit, so I can track that if I want to lower the cost basis. Collected 90 cents credit, and up to $1 credit. I'm just going to subtract the 90 cents. So break even is now 36.82 minus 90 cents, 35.92. Okay, so if I get it called away at 39, I make 308. I make 1540. on 3 accounts. 46.20 would be my profit on JD. I'm good with that. So now update this. Rolled. So we've got the 2/28 expiration, 39 by 30 collar for 90 cents credit. So the break even is 35.92. Huzzah. Okay, so I'm in there. Schwab dividend, Schwab growth, fine for dollar cost averaging. Growth is killing it. Looking a little bit better. It's up a couple of bucks. It's nothing crazy. I put like a $1,000 position, or I bought 100 shares. So SCHD and G up about $1,800 on growth, and still flat, about $300 down on dividends. But I'm just going to dollar cost average into those. Those are okay. The advanced decline line, stocks above. So here's above the 50-day. I mean, you can see that the stocks have ripped pretty hard. You know, I mean, a lot of stocks have ripped back above the 50-day moving average. The NASDAQ, same thing. A lot of stocks have ripped back above the 50-day moving average. Costco, I'm hoping that Costco has a pullback. High, low, lower, high, lower, low. I'd love to get some Costco in here. It is an expensive stock, so what I'll probably end up doing, rather than trading the options on this one, you know, ratio spread is great if I can generate a high probability of income. But I'm not necessarily looking to take on 100 shares at, you know, $800 or $750. I would maybe consider it, but it's got to be at the right price. So let me set a chart alarm on the 200 moving average, and I'll keep an eye on this. So if we have another high, low, lower, high, lower, low, I'm curious. Earnings are coming out sooner than later. Earnings in March. So the first part of March, we have earnings. Walmart, own some shares. I've got it collared at 100 by 80. Nike, starting to bounce off the lows, which is nice. I have a 65 and 60 put. That's looking pretty good for full profit. Home Depot, Lowe's, MasterCard back up towards highs. Visa back up to fresh highs. Wow, that's a crazy rip on Visa. American Express also up to fresh highs. We have earnings on American Express on Friday. This is a hypothetical that we talked about yesterday in class. So, you know, we were trading around 318. Do we get to 338 or get down to 298? I was looking for about a $20 move if I want to trade an earnings play on Amex. Johnson & Johnson, I've got to put at 140. Progressive, this one's out for less than 30 days now, but a 230 by 225. I would be okay getting a sign on Progressive. CB, this one's way out of the way, but this one should be fine for income. Palantir, I'm just going to wait for a pullback. This stock is ridiculous. Ratio spreads are looking pretty good. I'm out to April, May on ratio spreads. Carvana, I could care less. It's been a ridiculous runner. You know, I wish I bought it. I bought some. I just didn't hang on to it for the 1,000% gain. I bought Carvana when we came back into this low here. So that was you know, I look at it in hindsight, which doesn't help at all, but you know, that's a nice little head and shoulders trade. We break out and there's your measure move. So, I mean, we blew through that measure move, but it was still a good trade coming into, once I bought in at lows, I took it back up to the highs. So that was, you know, whatever. It was $20, $30 a share. It was okay, but obviously different to buy it at, you know, $40 and take it up to $200. Shoulda, coulda, woulda, FOMO. Redfin, Zillow stand out of those. Sector wise, we're still getting, so communication services, I've got a 111 trade on this one, looking pretty darn good for some income. That's $110. I did 2 contracts there. XLY is consumer discretionary. XLP for Staples. Staples like the worst performing sector this year so far. Energy still doing well. Got some cash secured puts on energy. Financials also doing well. I'm going to wait though. I mean, if we have high, low, lower, high, lower, low, let's say something like this on financials, if we come back to the 200 moving average, I will add more sector exposure, right? This is a pretty decent bar count. We are now 300 bars or so away from the 200 moving average. Okay, well, if we don't make this like blow off move or we stretch higher, I'm not looking to call the top. I'm just saying if and when we have a pullback into the 200, it's a lot more attractive for me to be adding some exposure to it. So I will wait for hopefully something a little bit more favorable price wise. XLV is healthcare, you know, coming in off the lows. Is healthcare going to get ripped this year by RFK? I have no idea. If healthcare is in this vicinity at 125 or so, I'll probably add some semblance of exposure there, but nothing yet. Industrials, basic materials, energy doing pretty well. They're like the big swinging sectors right now. XLB, basic materials, smashed back down to December, has come back in a nice way. Another one that I'm not sure where it wants to go. If this was a reversion to kind of catch up for that downfall, we're right back to kind of equilibrium. So is it upside or downside from here? I don't know. If we're downside, there's really strong support in the 70s. If it's upside, then we're talking maybe fresh highs up to $100 on materials. I could being the operative word, maybe look at some puts. I don't know if the IV is high enough though, since we've been going higher the last week or so. XLB, let's take a look at the IV. 42. I think I looked at this one yesterday. 82.95 XLB. Option strikes are going to be hit and miss. The options chain is not that great. We're going out basically month, and then we skip to like the next quarter. So I don't love that. If it went out to March, I'm getting 30 cents on a $8,000 risk. No thanks. Do I like materials that much? I'm not sure if materials are going to benefit from, AI infrastructure. I would think that they could, but let me check the sector again. And we looked at this a little bit yesterday. So this would be basic materials. Come on. All right. So LIN is the biggest weight. Sherwin-Williams, Ecolab. So this is one that I would be watching individually. I might just look at the stock right now. Newmont Corp, that's gold. So I'll look at this. This is copper and gold. Freeport-McMoRan is copper and gold. LIN, I don't even know what they do. I've never heard of that stock before, which is kind of sad considering it's 20% of the materials sector. LIN. Okay, for a utilities or basic materials, 33 price to earnings is pretty high, and it's also showing overvalued. Well, there you go. So, okay, let's go to Freeport-McMoRan. That's FCX. So this was actually a little bit better for me. I don't know if the premiums are going to be decent enough, but we're right back in the middle of all this garbage. So if I could own this stock down around $24, I'd be totally fine with that. So let's look at like a $28 to $24 ownership price, maybe something like a ratio spread. 36.2. We've got earnings coming out tomorrow. Interesting. Well, one way that I could do it would be I could put on a bull put spread for right now if earnings are positive. We've had our fair go of earnings, but more positive than negative. Let's see. Would I be willing to own some shares? Let me take a look at this one fundamentally. FCX. Are we good on time, by the way? I didn't realize I've been going for an hour and a half, but I'm giving back since considering you just watch me, open and close trades for 5 minutes. But if I'll wrap up here in another few minutes. I don't think I have anything on the calendar. I've got a meeting in the next hour, so I'm good. Okay. I like, yeah. I might just buy this freaking stock, man. So we got a 29 price to earnings. Loving that discounted cash flow model, and against the peers, peer average 24.9. Yeah, I don't mind this play. Now, the smart way to get into a stock like this would be to just do something where it's like, if I want to own it at $28 or less, then I just put on the trades to own it at $28 or less. That could be puts. That could be one way to do it. But I could start this process now. I mean, this has some solid technicals. Go to the higher time frame for a second. I mean, so the nice thing is all-time highs wise, we could get up to, let's say, $60. If I started establishing positions now, or at least some option trades around it, I could generate some income in here. I could take on some ownership in here. If it goes to the upside, either income. Boy, oh boy, oh boy. It's like, is copper going to rip this much? Copper and gold, but it's not trading spot price. I mean, we're new all-time highs on gold, or we're getting back up there. Gold's bid, like FCX may not benefit from that. But do they have a dividend? 1.49. All right, let me see what I can do here. So FCX, we've got earnings tomorrow. Let's go to Friday. I could take a really simple trade here. If I do a bull call spread, it's win or lose, right? If I'm right, I'll make 25 cents. If I go one strike higher, we're expecting about a $1.50 move. I'd rather, yeah. I'm just going to try to see if, oh man, these options are terrible. Let's go to March or April. April, I said I want to own it around like 28. These are all disgusting. So if I want to say I would own it at 31 by 30, that's the good and the bad. Fudge, man. I could do, let me see if I've got a level here that I like. FCX. I mean, it's only looking for like a dollar move. That's the issue that I have. Now, I do see a nice liquidity level around $41, which would be begging for a higher move on earnings. That would be out near term. Let's see. All right, I'd take this back to Friday. So if I buy the 39 by 39.50, or I buy the 38 by 39, I pay 57 to make 43. All I need price to do is stay basically above where it is. That trade, like, that's not awful. That trade's not terrible, actually. If I can get filled at 30 cents. If I can't get filled at 30 cents, I don't want to take this trade. So if I can make, I probably won't get filled at, yeah, that's fudge. Never mind. I was going to say, if I could only pay 30 cents to make 20 cents with a, in the money bull call spread, that would be fair. But now it's throwing 40 cents, which means I'm only making 10 cents. So that's garbage. So I could do this one for every $27 I'm risking, I'm making 23. Price has to stay basically where it is. So as long as FCX doesn't miss on earnings, which earnings is going to be when? Today, or I'm sorry, tomorrow morning. Tomorrow morning. Okay, tomorrow morning. Now it's up to 30 cents. My strike price that I'm interested in is 41. I'd like to see if I can pay less for this trade. That means price has to go up 25 cents. I like the head start. I kind of like this trade right here. All right, let's see. Are we missing something? That $41 level seems to be the play. I don't know. I'm going to hold off. It's going to be, I'll just make it hypothetical. I'm not going to freaking force a trade here. But I do want to keep an eye on FCX. Overall, I will say this. I'm just going to set a chart alarm. If we come down to, let's say, $30, I'm interested in owning some shares. Pretty simple. But I will exercise some restraint and patience and wait. So let me set a chart alarm here around $28. And at the money trades are a lot better premium. Like example being, if I did a 39.50 by 39, I get 22 cents credit. If it goes to the downside, I would be willing to own the shares, but I'm doing this out for only a couple of days. That's not worth it. If I went out farther, anyway, I'm not going to take an earnings trade on it. I think 41 gets hit. I'll just make a note here. $41 liquidity level. I'm just curious if it gets hit. But it's such a hit or miss on earnings. You never know. Ratio spread, no, the premiums are crap. If I went out to April's 85 days, if I looked at a ratio spread, I'd have to be willing to say I want to take like a 31 by 30. I mean, look at that. For a ratio spread, you're only getting like 10 cents premium. That's awful. So it's not worth it. Not worth it at all. I'll just buy the shares. Not now. Let's say like if it comes back to 30 bucks or 29 bucks, I'll just buy shares. Or I can put in a cash secured put at the money, which at the money for let's say 30 days out would be about $1.50 to $1.60. Like that is way better credit. If I do get assigned or don't get assigned, that's at least an income play if I don't get assigned. Okay. All right. A couple of things. Let's go back to currencies. I'll spend it's 11:53. Just give me a few more minutes here before I wrap up. So dollar index on the week, pulling back a little bit. I was hoping to see that if the dollar is going to continue to pull back, and I'm not sure about this, but if we have a big pocket that was filled, if this area on the dollar is going to set up for some type of head and shoulders trade, perhaps the dollar can correct. I still think the dollar maintains bid around this like 105.50 to 106. Okay. I think that is a support level on the dollar. So even if we have a decline in the dollar, I am still looking to get long or stay long. Look, the dollar long, if I'm correct in this trade, dollar long is not a good thing. As far as the overall equities market, dollar long is not a good thing, right? If this is long, this means that US 10-year is also higher. So I would like to see the dollar correct in some fashion so the US 10-year can go with it. And then we can discuss like, okay, if this starts to elevate again or the dollar starts to get stronger. But a weaker dollar for right now would be a little bit of a relief, which would be nice. But I'm still not bearish on the dollar. I'm just going to wait and see if I can buy the dollar somewhere in here and then resume the uptrend. Okay. And then fundamentally, that could be a very painful trade. If the dollar gets stronger, that could be very painful for the equities market. And that would be like the second wave of inflation field. That'd be a lot of pressure on equities if the yields are rising. So SPY is creeping up towards 607 and change. They're getting up there. 610. Okay, 610 could be a target by Friday. I put it SPX trading this morning that didn't get filled. I'm curious where it's at right now. Same thing as yesterday, just doesn't have enough. The IV is still super low too, so I'm just not getting the premiums that I want. This will probably not fill today. Fine. All right, let's go currencies. So dollar related currencies, Aussie dollar. I'm still long on some small positioning on Aussie dollar. If this pulls back into this breakout level around 6,400, I'm going to take some profit on that short-term trade. Trump definitely wants a weaker dollar. If Trump wants a higher equities market, we're going to have to see a weaker dollar and lower yields. It's pretty simple. I don't think there's any way that the indexes can go higher with the dollar getting stronger and the yields getting higher. That is a correlation I'd be shocked to see. Anything can happen, but it's highly unlikely that we would see so much pressure coming in, higher yields and higher inflation, and the market's like, we can still go up 10, 15, 20% a year. I don't think there's any freaking way that's going to happen. It's already been a pretty stretched bull market in the end of 2024 when it was essentially led by 10 stocks only. So I think Trump definitely wants a weaker dollar. Whether he gets it or not remains to be seen. It's like inflation readings with the Fed pausing. And right now, the Fed is looking to not touch anything rate-wise until June. There's a lot of data that's going to come in, job number-wise and inflation-wise over the next 4, 5, 6 months. Okay. All right. Anyway, Swiss pairs. I'm going to go Aussie Swiss real quick. Still liking my long, still holding my carry trades. CAD Swiss was looking good, but this seems to be still kind of range bound. So lots of range trading here on CAD Swiss. I still like buying the dips though. Buying the dips, buying the dips. Eventually I see this breaking out and going up. Might be a while. We might come back down and revisit flash crash lows, but I'm still buying. This is area 1 and area 2 that I'm still going to be accumulating some small positions on CAD Swiss. Euro Swiss looking better. Had a nice little bottom here on 92. We're back up to 94.50. I'm trying to hold off to this one for at least a 97 to 97.50, but ideally 2 spots of profit on my Euro Swiss longs would be here. So about 97 and 99 would be my 2 spots. Okay. I'm already in this trade with my Forex account. If you wanted me to post this through Pulver Alerts, I would be willing to do this. Buy and buy and buy, and then stack up some orders. I think we get to this pocket, and I think we get to this pocket. I think we have a chance to get up to 99. So if you're willing to take a little ride with me and dollar cost average, it'd be small, 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 but stack these up to maybe, maybe $1 to $5 per pip. And net position wise, like 95 to 99. If I could grab 400 pips on a $5 position, I'll make a couple grand. That might be I'll take that trade. So I'm already in for, I've got like 20 positions on Euro Swiss. I closed out it was like 27 positions on dollar Swiss when it hit 92. So that was a big winner for me. But Euro Swiss, I'm going to look to try to get this thing back up to 99, but not be greedy. That'd be good enough. That would be good enough for profit right there. But I'll throw that in for, I'll do that in the Pulver Alerts. So look for some Euro Swiss positioning. I'll start stacking these in. Okay, Pound Swiss, I'm still long. I'm trying to get back to 119, 120 on that one. New Zealand Swiss, still measuring some symmetry. All the way back to 56 is fine. Looking for a 5-wave move. Dollar Swiss, I took profit. Euro Aussie, Euro CAD. Just, I don't know. Be careful, man. This is like you're trading V tops and V bottoms here. This is nuts. Pound CAD. Again, be careful. Maybe a topping pattern, but I'm not sure. Right? I'm not sure. I'm just staying out of it. These commodity pairs that are high volatility, like Euro Aussie, Euro New Zealand, Pound Aussie, Pound New Zealand. Be careful. I'm just staying out of them. There's a lot of volatility, a lot of chop. Not my favorite. So I'm going to steer clear and just hang in there for some trades that I really like. It might be a dollar basket that I like. It might be the Japanese yen basket that I like eventually. And I'm just going to hold true on some of the Swiss pairs. Okay. All right. That being said, that was a nice little segment today. And happy to spend some time with everybody. So off we go. All right. I'll let you go for today. I'll see you tomorrow. Thanks. Bye.
Thanks for watching today's A1 Trading Show. We hope you enjoyed, and we're excited for a brand new year of trading with you. If you're new, consider subscribing for daily videos and live streams all year long. Be sure to check out the description below for our latest deals and offers. 2025 is just the beginning of our best year yet. We'll see you tomorrow.